Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel, will be joining us for the hour. And in 30 minutes, we'll talk to Alex Zhu, CEO of Yami, about the strategic investment from Mitsubishi. And we want to hear from you as well. It's on First Call, of course. Reach out with questions on North American large cap stocks, and we'll have Brian Madden answer as many of them as he can at the end of the show. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you want to go that route, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Tesla are down in the pre-market, despite the company posting a profit beat. Actually, the market's right now down overall. You got the Dow futures off by 0.38, NASDAQ by 0.15, and S&P by about the same. As companies react, you can see Tesla, people reacting to their news. We're going to talk about a little more about that in a minute. The company posting a profit beat. Immediate reaction, though, comes as Tesla says capital spending will top $25 billion US this year, well above expectations. The company is ramping up investment in AI, humanoid robotics, and the Cybercab platform. Elon Musk says the heavier spending is meant to set the stage for much larger vehicle production down the road. Teck Resources posted first quarter profit that more than doubled from a year ago. The miner also reported revenue that beat expectations, coming in at nearly $4 billion. The company says the strong quarter was driven by higher copper sales and solid operations. The results come as the company continues work on its previous announced deal with Anglo American. Shareholders have approved the transaction with regulatory approvals still pending. Shares of Lululemon are falling in the pre-market after the company announced former Nike executive Heidi O'Neill will take over as CEO. O'Neill spent more than 20 years at Nike and is set to step into the role in September. She takes over at a tough time, of course, weak sales, rising competition, and that sizing controversy recently. Lululemon shares are down more than 35% over the past year. All right. Time now for our top-line story. We're digesting a slew of earnings from both sides of the border. Let's see what investors should be expecting this earnings season. Joining us now is our guest for the hour, Brian Madden, Chief Investment Officer of First Avenue Investment Counsel. Brian, thanks as always for joining us. Lots of earnings. For the most part, they've all been pretty good.
Yeah, so far so good. It kicked off a week or two ago with the big U.S. money center banks, and they made a lot of money, as they often do, and they're important bellwethers for the overall economy. Signals of credit impulse, credit expansion, credit contraction. So you can glean a lot of signals about how the rest of the picture is going to evolve just from reading the tea leaves there. But now we're starting to get a trickle of earnings from other companies, and they're looking pretty good.
All right, let's talk about Tesla, because everybody talks about Tesla. Interesting, the earnings were good, but it's the spending I think people are wondering about.
Yeah, I mean, this is always an ever-evolving story, Roger, as you and I know, and viewers no doubt also know. It's electric vehicles initially, then it's battery storage, and then it's autonomous taxis. Now it's robots, and then we've got the whole distraction of the SpaceX IPO likely later this year. But mixed results, and they're spending an awful lot of money. And I think investors are sort of treading with caution here, as they are with many of these companies, the big Mag 7 names that have big and ambitious CapEx plans, and people are starting to question what's the return on invested capital ultimately going to look like here. And
it's interesting because we said that it's going to be going on towards AI initiatives, humanoid robots, and the cybercabs, but not so much the car per se.
Well, and let's not forget, beyond that, they're also working to develop sort of vertical integration, developing their own semiconductors. So there's just a lot of different things going on here, and all of it kind of eats money and payoff. Certainly, we know innovation is their forte. The question is, will the returns on these investments justify the lofty valuation on the stock?
He does seem to defy. Well, he seems to defy everything. Much.
It's a cult stock, really. Like it's the Elon Musk show. Let's just call a spade a spade.
Another one that came out, IBM, quarterly sales and its software unit in line with estimates, but they're still down in the pre-markets.
Well, yeah, I mean, this one is another sort of bellwether for what we've taken to calling at First Avenue Investment Council the second inning of the AI revolution, wherein the first inning, which let's roughly date that one starting at the birth or inception of ChatGPT around November of 2022, till about last summer, that first inning was really characterized by all-in euphoria and exuberance, and investors just wanting to get long of AI 6 ways to Sunday. And the second inning kicked off last summer with people starting to say, well, if AI is as disruptive a technology as it purports to be, who's going to be disrupted? And right in the crosshairs have been a lot of these legacy software and software as a service stocks, IBM being one of them. And in fact, Roger, this is not sort of breaking with the pattern. A lot of these companies continue to put up good revenues, good earnings, maintain guidance, and yet the doubts don't fade, and you see it in the trading of the shares.
And IBM even said it's been integrating AI into everything it's doing, and this is still...
Well, and as have all of these software companies for the most part. And so, really what that sort of begs the question is, is AI going to really confer an advantage that's sort of outsized, or is it just starting to become table stakes? Probably it is.
And I was just reading one analyst saying that a lot of people, their customers, are delaying purchases with IBM while they're testing out tools from AI firms to see if it replaces IBM.
Yeah, and we think there's a lot of this sort of trial and testing and waiting for the latest and greatest. And I mean, AI is moving at breakneck speed, and what was possible 4 years ago, we're running circles around that now. You've got agentic AI and lots of sort of step function increases in what it's able to do, and the accuracy and reliability with which it's able to do it. So I think a lot of people are saying, it's sort of like, do you buy this year's iPhone or do you wait for next year's, because it'll be just that much better?
Yeah. And with IBM, I mean, they're international business machines, and they're a massive company. Can they pivot and work with AI, or even transition totally into AI?
Well, it's a big ship. This isn't a speedboat; it's an ocean liner. So can it? Maybe, but it will take a long time to pivot a big ship such as this one.
All right, and one other. Let's get to this one. Tech coming out, their revenues beat estimates. Any surprises there?
No, I think it's not surprising, and we're seeing this in the commentary from some of the other miners. Yes, we know the prices of their output are up on a stick. The charts look good, and so in Tech's case, that's copper primarily. Copper's turning around $6 a pound. That's in sort of rarefied territory. We've not seen it there really sustained for any period of time. And so copper is, they used to call it Dr. Copper, the metal with a PhD in economics. Now we're increasingly starting to think of it perhaps on the verge of being a strategic metal, given its role in some of these new economy initiatives. Yeah. So we know all that. But the other side of the coin is, what about the input costs? So mining, you dig the stuff out of the ground, that's all well and good, but how do you do it with machines? What do the machines need? Diesel. So that's affected by the Straits of Hormuz. And then you run it through a milling circuit, which involves crushing the ore and then leaching it with chemicals and acid to extract the copper concentrate from the host rock. And so the prices of all those chemicals are also affected by the supply chain interruptions in the Straits of Hormuz. So Tech, I think, is saying, okay, whoa, let's not get too excited here. The output market is good, but the input costs are very inflationary. So that might temper enthusiasm for the shares in trading today. And of course, in the background, we've got this big, very strategic merger with Anglo-American awaiting approval.
All right, we'll take a break on that note there. Up next, we'll take a look at the markets before the bell, and we'll discuss best performing stocks in the S&P 500 and TSX over the past 25 years, the Wayback Machine. See how the markets are shaping up this morning. We'll start with U.S. futures. And you can see there's, the NASDAQ and the S&P 500 are almost a wash right now. And the Dow, it's pulled back by about 0.3%, but they're all hovering in, near, above record numbers. So nobody knows what to do right now. Everybody's just sitting and waiting after that update yesterday. And heading to Asia now, take a look at the markets from yesterday, or from this morning. And you can see an off day for all of them. Nikkei down by 0.75, Hang Seng by nearly a point, and the CSI 300 by 0.28%. Off to Europe now, and it's same. It's a mixed bag. You got the FTSE down by 0.62 at 10,400. The CAC 40 is up by 0.4, and the DAX is down by 0.2%. TSX yesterday finished just below 34,000, pushing up again. And some of the movers and shakers, Curaleaf up 25.66% on reports that maybe might see some cannabis regulations easing down in the state. Rogers up 13.5% on its report, and going the other way, BRP down by 5, Altus by 8.5. Looking at gold now, and it's fairly flat right now, just about 47.50. Silver's off by 2%, down below 77, and copper, as we were just talking about, hovering above $6 and up by about a point right now. Western Canadian Select yesterday, and that upward pressure on the Straits of Hormuz, was up by 3.21%. And for today, WTI, how's it responding? It's off slightly right now. This is just the way the markets are going right now. Up about a half point at $92.50 a barrel. Okay, well, Canada and the U.S. stock markets have delivered nearly identical long-term returns. Those returns have come with major drawdowns, underscoring why position sizing is critical to surviving volatility. For more on this, let's bring in Brian Madden from First Avenue Investment Counsel. Talk a little bit about this and what you're talking about. Let's bring in the 100-baggers and the 500-baggers. Talk about that first. What is that?
Yeah, absolutely. And I love that we led into this by looking at the best performers on the market yesterday. This is maybe running a bit contra to popular culture in this era of crypto and meme stock and zero-day to expiry options and everybody wanting to make the fast buck. We at First Avenue Investment Counsel don't believe long-term investing is dead. And as sort of an interesting research project, one thing that we undertook to do was look at the end of last year, so we're a quarter of the way through this century, what have been the best performing 10 stocks in the TSX Composite and the S&P 500 over that time frame. So not surprisingly, there's going to be some familiar names like NVIDIA and Apple and so on.
I guess banks here.
No, interestingly enough, they did not make the...
Over the 25 years?
No, so they didn't creep into the top 10. Brookfield in the financial realm did, but there's some surprising names. I think we may have an exhibit, but...
There you go.
So these are the Canadian names. So Stella-Jones. So one of the big takeaways is, number one, these are not all tech stocks. In fact, there are no tech stocks on this list. There's only 2 on the U.S. list. Stella-Jones makes rail ties and utility poles, so proving boring is beautiful. TFI is a trucking company. When we showed the U.S. board, there's a trucking company there. We've got a convenience store. We've got a T-shirt maker and a heavy equipment dealer. So, not always is all the sizzle in the tech stocks. So that's takeaway number one. But if we sort of size up these Canadian stocks, on average, that list of 10 has averaged 10,236% return since the turn of the century. Now, if we turn our attention to the U.S. names, the granddaddy of them all, the top of the leaderboard is NVIDIA. So yes, that's a tech stock. So is Apple further down the list. But again, there you've got Monster Beverage, that's energy drinks. Old Dominion is a trucking company.
Tractor Supply, TSC.
Yeah, so this is Rural Farm Supply and Equipment Store. So again, the mantra holds, even in this tech-heavy market, boring can be beautiful. Now, what's interesting in point of contrast here, these U.S. superstar names are on average 500 baggers. So I'm just going to look at my notes. 58,187% is the average return of these 10 stocks since the turn of the century. Now, all the sizzle and all the hoopla and the fireworks is probably focused on that first column. But we think investors should not neglect the second column, so the maximum drawdown. So this is the big takeaway. This is why we think long-term investing requires conviction, fortitude, and a long-term view. Because as those tables show, all but 2 of these 20 stocks have at least once in this quarter century during which they've been massive compounders been cut in half. And on average, among these 20 names, they've been drawn down 70% from peak to trough at the maximum during this 25 years. So The other really important takeaway, we think, is position sizing and portfolio construction and discipline matters, because although you want to be around for the ride and be able to sort of see these through their ups and downs to get these 10,000 or 50,000% returns, you need to size the positions correctly, because enduring a 70% drawdown in one or more names that have an outsized weight in a portfolio can shake you off of the train, and you miss the ride. So you want to be disciplined in trimming and taking profits partially along the way.
Are the drawdowns the one connection between them all, or is there something else that shows up on all of them?
No, so they're very idiosyncratic. So, I mean, there's a place for thematic investing, but we also think there is very much a place for disciplined and diversified portfolio construction, looking for idiosyncratic, best-of-breed players across all of the 11 economic sectors. And, I think this is a really illustrative example that you don't necessarily have to go all in on tech or all in on gold or all in on energy. And in fact, you shouldn't. And
how do they compare to the rest of the market on their returns over the last 25 years?
Oh,
are there other companies? Did you do other companies that?
Well, I mean, they just absolutely, completely leave them in the dust. So for contrast, the compounded annual return for the S&P 500 over that period, 8.06%. For the TSX, 8.01%, so nearly identical. 8% compounding for 25 years gets you to sort of a 4 or 5 or 6 bagger. These things are 100 baggers and 500 baggers, so it's no contest.
Home runs, grand slams.
Totally.
Like double grands. It's hitting 2 grand slams in an inning.
Yeah, and throwing a perfect game at the same time. It's a real stand-up performance from all of them.
And are they looking, when you look at those companies, are there any forward pressures that you can see with them, or are those companies that kind of just keep chugging along?
I mean, we own quite a number of them, and in fact, in keeping with our long-term investment philosophy, have owned a number of them for a long time. But I can't say we've gone, deep in the weeds on all of them, because we don't own all of them. But of those we own, we think they have enduring competitive advantages, structural profitability, incumbency, and great leadership, and we think they've earned the right to continue to win among those names that we do own, and we own probably 6 or 7 of them across those 2 lists.
Okay, all right, we'll take a break on that note there. We'll be back and see why Agnico Eagle is on Brian Madden's radar. Okay, time to see what's on the radar for Brian Madden from First Avenue Investment Counsel, and one of them, Agnico Eagle. What are you liking about them, Brian?
So, Roger, as you probably noted, this company had a very busy weekend, a newsy weekend in terms of merger and acquisition activity. On Monday, they announced about $3.7 billion of investment to acquire 3 companies, several of which, well, all 3 of which they already had toeholds in. So, Rupert Resources was one of them, Orion Gold or Orion Mine, I forget exactly what it's called.
Orion Resources,
Orion Resources, and then FinGold JV, where they owned a 30% stake, and B2Gold owned the other one. So this is a company that we've liked and owned for the last 4 years. It operates 10 active mines in Canada, mostly in the north, in Finland, and in Mexico and in Australia. So number one, these are politically safe jurisdictions where the government's not apt to pull the rug out from under you. Very good management team, very credible, usually meets their guidance. They've paid a dividend every year since 1983. We really like these deals. In particular, one of them, the Rupert Resources deal. So first of all, they already operate the Kittilä mine, which is the largest primary gold mine in Europe. That's in the Lapland region in Finland. All 3 of these deals are in the Lapland region in Finland. So as a result, they're synergistic. They're going to unlock $500 million. So that's 14% of the deal value in operating capital and development cost synergies by sort of having this consolidated set of property. They will also realize a 7-fold increase in their exploration acreage in this very prospective and mineralized belt. And Rupert Resources, in particular, we think is the crown jewel amongst all of them. So they already owned, a good-sized slug of it, more than 10%, maybe less than 20. And so now they're going to own all of it. But they structured the deal in an interesting way. It's a share-for-share exchange. Valuation is about $12 for Rupert, so a big premium. But the kicker for the Rupert management team is there's another $3 of incentive, or conceptually like an earnout, contingent on this company releasing proven and probable reserves of 5 million, 7.5 million, and 10 million ounces of reserves once they drill out the property. So just to sort of put this together, Agnico in total across their 10 existing mines and all their other exploration properties has 55.4 million ounces of proven and probable reserves. So this one acquisition alone, if it drills out the way they think it could potentially add another 10 million. That's an 18% increment to the resources. And the aggregate purchase price for all of this is about 3% of Agnico's current market capitalization. So in scope, in region, synergistic, financially accretive, and great price per ounce of reserve that they think they're going to unlock here. So we like the stock. We like it even more after this week's news.
All right, let's get a couple more in here. Booking Holdings, I always think, what the heck is Booking Holding? Booking.com for most people?
Yeah, so Booking.com is their flagship banner. They also operate Agoda, OpenTable, Priceline, and a number of other banners, some of which are region-centric. But it's the number one online travel agency, and it operates effectively what's a three-player ecosystem with themselves in the middle, operating sophisticated payments and AI platforms, and intermediating between travel providers and travelers. It's a company that initiated a dividend a couple of years ago. It's twice increased it. It earns very high margins, very high returns on invested capital. And it's increasingly realizing operating expenditure savings through smart use of artificial intelligence, both to cut costs but to enrich user experience. We really like that they are very good and strategic about partnering with third-party traffic origination platforms and referral sources like Google, Meta, and increasingly the large language models. So this stock really sold off from last summer, along with some of these other software as a service companies. We really think that this is a case of a software baby thrown out with the bathwater with the pullback in the price. It also split 25 for 1, so that might make it a bit more enticing to the retail crowd recently in the last couple of weeks.
Any concern? I'm just seeing this story coming up, facing a deceptive practices probe over preferred hotel networks in Italy.
So we saw that yesterday. The stock pulled back about 5 or 6%. So we just think that sets up a better entry point. I mean, if you're sort of a big dominant player operating in electronic markets and platforms, especially in Europe, you're going to find you're in the crosshairs of regulators, as all the big Mag 7 companies have found out the easy way or the hard way in one form or another over the last decade or more. Right, so not too worried about that.
All right, we'll wrap it up on that note there. Still ahead after the break, Mitsubishi is hoping its latest investment in an U.S. Asian grocery startup will finally crack open the North American market for thousands of Japanese food brands. That's next. And our phone lines will open soon for our first call segment. You can reach out at 1-855-326-6266. Send us an email as well. First call at bellmedia.ca. Shares of Lululemon are falling in the pre-market after the company announced former Nike executive Heidi O'Neill will take over as CEO. O'Neill spent more than 20 years at Nike and is set to step into the role in September. She takes over at a tough time with weak sales, rising competition, and that recent sizing controversy. Lululemon shares are down more than 35% over the past year. Waste Connections posted first quarter revenue and profit that beat estimates. The company says results were driven by solid organic growth and pricing strength. The CEO says the company is well positioned for the full year despite rising fuel costs and tough weather conditions. Management also sees potential upside from its strategy of continued acquisitions. Mullen Group posted mixed results in the first quarter. The company slightly beat expectations on revenue, while profit came in line with estimates. Despite this, the CEO says the year is off to a good start with acquisitions continuing to drive growth. Murray Mullen says general market conditions are showing signs of improvement, adding that March was one of the strongest months they have seen in some time. And a quick look at the U.S. futures right now, and you can see down day after the rally yesterday is Strait of Hormuz is what plays on everybody's minds, trying to figure out the next move there. Dow off by 0.38, NASDAQ by 0.14, and the S&P 500 about the same. Mitsubishi has made a strategic investment in Yami, a U.S. online marketplace for Asian groceries, beauty, and household products. And Yami is now expanding into Canada with a new Toronto fulfillment center. Here to discuss this partnership and more is Alex Zhou, the CEO of Yami. Thank you very much, Alex, for joining us. We appreciate it.
Thank you for having me today.
Talk a little bit. What is Yami, first of all? You're coming into Canada, but what is it? What are you doing, and what will you be doing in Toronto?
Yes, we are the largest Asian product and Asian brands e-commerce based in North America. You can think about as mini Amazon for Asian product and Asian brands.
Alex, I'm interested in your expansion into Canada, and in particular, as I'm sure you're aware, Loblaw is sort of the dominant food retailer in this country, and they also saw the appeal of tapping into the ethnic market, manifest via their acquisition of T&T, the Asian grocery store chain, about 12 or 13 years ago, which they've expanded to something like 30 stores in Canada and are sort of sticking a toe in the water in the States. So as you enter the market here, wondering what you're thinking to do to differentiate yourself from that banner in terms of either assortment or go-to-market strategy, given the incumbency advantage that they have in that niche?
Yes, of course. First of all, Canada have a large population of Asian populations, right? And also, of course, like T&T and Loblaw, they have been in Canada for years. Customers love them, but we are essentially an e-commerce company. We do see this gap, for the Asian product, Asian brands online. Right? That's what we're good at. That's why we think, okay, for next move for us, we should expand to Canada. So all the Canada customers can have easy access to Asian product and Asian brands online. That's the main reason why. And why now, we want to step into Canada market.
And now you're teaming up with Mitsubishi. Is the focus going to be more Japanese products, or are you talking a wider Asian group of products?
I think, our strategy is still, we're going to provide customer broader Asian product, not only Japanese product, but also, from Korea, China, Hong Kong, Taiwan, mainly Asian countries. But since we're backed by Mitsubishi, we're gonna have a lot of more selections from Japan. Can provide to Canada customers. Let's also to echo what your last question. We can actually provide more unique, more selections, from Japan, to Canada customers. That's how we can differentiate us with T&T, Loblaw.
And with the products, what about Amazon? I mean, are you not competing with Amazon in many ways for a lot of these products then?
We are laser focused on Asian product and Asian brands. That's the main difference between us and Amazon. For example, we are in US right now. Amazon and US is Amazon's home base, but we still manage to grow super fast. We have millions of customers here because we can provide unique positions. Customer can find all Asian selections from snacks to food to cosmetics, beauties, all one stop from Yami, right? But if you go to Amazon, you have to dig into Asian selections in millions of sections. I think it's not a very good shopping experience, especially for some customers. Oh, I just want Asian product, Asian brands.
So, Alex, digging a little bit more into this Toronto fulfillment center that you're building, just wondering sort of what specifications that's being stood up to, and particularly, wondering if it's going to be able to accommodate cold, fresh, frozen, and so in food service, again, getting back to the T&T competitive assortment decisions, are you going to be able to manage a supply chain that would encompass fresh and frozen and vegetables and produce and meat and fish and some of the things that you see in the T&T stores? Or will this be dry, non-perishable goods in the food service part of your assortment?
Yeah, for first step, we're gonna focus on non-perishable. So we don't carry fresh and underproduced. That's what we're good at, right? We really good at the non-perishable selections. That's one of we can provide way more selections, non-perishable, all categories. Again, this is also one of how we gonna step into the market, how we gonna differentiate us with TNT and other Asian grocery stores here, right? So that's what we good at. Simple answer, first step, we're gonna only provide non-perishable items.
And is there going to be a bricks and mortar store, or is this going to be delivery? And are you only in Toronto right now, or are you looking? Vancouver, to me, would be another obvious market for you, I guess.
Yeah, we are eyes on all market in Canada, but our first fulfillment center gonna be in Toronto, right? So, but they delivery to the whole countries.
Okay, so you'll be able to order, and there won't be a storefront to it. How long have you been in the U.S., and how different are you finding it from the U.S. and Canada?
Yeah, we've been operating in U.S. over 10 years, right? I think if you think about Asian populations, Asian customer behaviors, I think Canada and the U.S. are similar. That's also one of the reasons why Canada market is our first international move, right? Because we can duplicate our customer know-how, so we can provide the same customer experience to the Canada customers. But one of the major difference, is I think it's just Canada have a larger percentage of Asian populations, but the number itself is actually smaller. So that's also we need, when we step into Canada market, we need to think about, okay, how big is our warehouse, how large gonna be our sections, everything. I think other than that, two countries Asian, in terms of the Asian customers, are similar.
And with that, you mentioned about the smaller numbers, also geography-wise, Canada's a massive country. How are you going to manage? How will you be able to control prices with some of the deliveries that you're going to have to do across the country?
Yeah, I think that's what we're good at, right? One of our main strengths is our international supply chain, right? Especially after backed by Mitsubishi, right? We can actually handle Asian product, Asian brands better than all other competitors. We can actually get larger selection, but with cheaper, lower cost. And also, in U.S., right? U.S. is also a large country that we have multiple warehouses in U.S. We can do same day and next day delivery. To 70% of our customers. We're gonna offer the same experience to our Canada customers as well. Mm-hmm. We are pretty confident about how our operations, our sections. We have over 1 decade of experience on this. So we've been eyes on Canada market for years, right? But finally we think, okay, we are ready now in terms of the resources, in terms of the sections, in terms of the talent. Once we open Canada market, we want to deliver the best price, the best experience to Canada customers. Okay. That's why we wait so long to step into Canada.
Okay, Alex, thank you very much for joining us today.
Thank you for having me.
Alex Zhou is CEO of Yami. Still ahead, Lululemon is out of favor in the pre-market as the company announces a new CEO. We'll discuss why investors are unimpressed with the news. And of course, our phone lines are open. Brian Madden is taking your questions on North American large cap stocks. You can reach us at 1-855-326-6266. Email firstcall@bellmedia.ca. We'll be watching shares of Lululemon as the company names former Nike executive as its next CEO. The move is supposed to help weather a turbulent period of slowing growth. However, this decision seems to be leaving investors unimpressed about Heidi O'Neill. So let's bring in Poonam Goyal, senior analyst for U.S. retailing at Bloomberg Intelligence. Poonam, thank you very much for joining us today. The market's not impressed with Heidi O'Neill, but it looks like she has a pretty good CV.
Yeah, she does. She has definitely sportswear experience. She's been at Nike for over 25 years, so has the expertise in the sports apparel domain. The thing is that she's never held a CEO's position, right? So there's a little concern around that. And then there's also some concern around the start date. If you think about where we are today in April, she's starting after September. So it's a long way there. And I guess the question is, what should we think about Lululemon over the next 5 months? Are things going to materially decelerate before we can see some, sign of light?
And has she left Nike, or will she be working with Nike until August or something like that?
It's unclear when she will leave Nike, so we don't know if she will be at Nike, through the summer, or whether she will depart Nike and will be taking a short break. That is still unclear, though it just means that the turnaround is pushed forward just longer, right? So now it becomes a 2027 transition year versus potentially could have been 2026.
I guess, though, it gives her some time to sit and think about what she wants to do with the company. It's had its share of challenges.
It definitely has, and Nike and Lululemon, while they do compete in the same sportswear industry, they are different, right? When you think about Nike, it's about a real focus on performance and sport. And while she did lead the women's division there, Lululemon is, I would say, sports with fashion combined. So it's somewhat of a different beast to tackle. And it'll be interesting to see what problems she kind of isolates out first and tackles first, and how she goes about it, because the competition has risen. It's risen from everywhere, whether it's Alo Yoga, whether it's the Nikes of the world, or anywhere. How does Lululemon continue to set itself apart and really drive increased customer intent?
And what do you see as some of her strengths for this, and maybe some of the weaknesses?
I'd say the strengths are just having that sports background, right? She has that background in sports apparel, which is obviously great for this role. In terms of just some setbacks, she's never held the CEO role, as I said earlier, right? So we don't know what her leadership style really is. And we haven't heard much about her while she was at Nike either. So there's really little visibility on her strategy and her way to lead turnarounds. She has made a difference in the women's business there, but that was a very small business to start with when she, brought it to growth.
Now, we're seeing some reaction from the markets, but have we heard from Chip? As in Chip Wilson. Has he any comments on this?
Not yet. I have not heard as of yet. So I'm sure we'll hear something, but we haven't heard anything yet. She also has to manage those expectations, right?
Yeah, there's a lot of outside things. I mean, and you had also who was the investor? Just went out of my head. That's been pushing this as well. The investor group that's been Elliott. They're also yeah. Been very vocal in this as well. Anything from them?
Nothing yet. Clearly they may have a comment, and we may hear something as the summer goes, or even sooner. But I think, look, they needed a leader. They needed someone who had a sports backing. Calvin McDonald did not have that. So I'd say on the positive side, that is a strength. We'll have to kind of give her a chance to speak and state what she views this turnaround to be and where she's going to invest first in it. So it's a wait and watch story for me right now. I don't think I can say it's good or it's bad at the moment. But when she comes in September, I think we'll have a chance to better assess where she wants to go with this, and then have a more meaningful reaction to whether she can lead this turnaround or whether she will have many obstacles in front of her.
Okay, Poonam, thank you very much for joining us. We appreciate that update.
Sure, thank you.
Poonam Goyal is senior analyst for U.S. retailing at Bloomberg Intelligence. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including an upgrade for Rogers. All right, let's take a look at some of the notable analyst calls and recommendations. TD Securities updating their rating of Rogers Communications to buy from hold with a price target of $60. At the same time, RBC Dominion Securities and National Bank Financial both reiterated their outperform rating on the stock, citing positive reaction to CapEx cuts and higher free cash flow. Going the other way, National Bank Financial and Desjardins Securities both cutting their price target ratings on Metro after the company trimmed EPS estimates due to food competition and the Quebec strike. National Bank, or strike uncertainty, I should say. National Bank Financial maintained a sector perform target cut to $105. Desjardins Securities target cut to 97, but maintained a hold rating. And when we come back, Brian Madden will take your questions on First Call. Time for First Call and first email, and that is from Tony. What's Brian's take on TELUS? Will there be a turnaround soon?
Thank you for the question, Tony. We don't think there'll be a turnaround soon. We had been out of the stock for years, bought it early last year, sold it early this year, kind of round tripped. We didn't really make money or lose money on it, inclusive of the dividend, but we're glad we sold it because it's moved lower. And, basically our thesis was negated. We'd thought competitive intensity was going to wane when we re-entered the name early last year. It didn't. We now recognize there are sort of population growth headwinds given the change in Canadian immigration policy, and telecom, of course, is a per capita business. We all might have one or perhaps two phones, but I don't know too many people with three. And then, of course, there's concern about the sustainability of the dividend. The payout ratio is high. The dividend yield is sort of a siren song. It's tantalizingly high, but cautionary tale is BCE, which cut their dividend sharply last year. So just didn't see compelling total return prospects there. And some of the other catalysts we'd identified, like repurposing surplus urban real estate that used to be copper-based switching centers into residential housing, looks like it's been kicked down the road, given that the housing market is kind of frozen and glutted with supply. So we saw a better opportunity elsewhere and don't see a turnaround anytime soon here.
All right, let's get to a caller. Alfred.
Yeah, thank you for taking my call.
Cheers.
My question is on Berkshire Hathaway, medium and long term. The stock has been trading sideways for a long time. Thank you.
All right, and Alfred's calling from Mountain View, California.
Yeah, a long way away. Thanks for the call.
Yeah,
thanks
early.
for the question, Alfred. That's right. Yeah, crack of dawn over there. We don't own Berkshire Hathaway. This is a stock, but really it's sort of like...
It's a way of life, isn't it?
Well, yeah, it's sort of a cult stock too, I guess, in some sense. But, it's as much as it's a stock, it's sort of like an actively managed portfolio of mostly U.S. Equity. And so we're active managers ourselves. So we think our job is to go out and sort of rifle shot and pick our best ideas. Now, having said that, if you sort of want to buy into this investment and management philosophy of buy and hold forever, very high quality, iconic, enduring companies with big competitive moats, this is as good a way as any to do it. And, back to the segment we had earlier, Roger, about long-term investing. You can't get too fussed about a stock trading sideways for a few months or even a year. The long-term track record of this company growing and compounding, creating shareholder value is unassailable. We think that will endure even after Buffett's retirement. The company still has a first-rate collection of businesses and is in good, strong governance and leadership hands. So no qualms about buying it, even though we don't own it.
Yeah, I was going to ask, it's been soft, is that the response to Warren Buffett officially kind of stepping down or no?
No, I don't think so.
Or just some hits?
One of the bigger businesses within there is in insurance. Of course, the whole idea is they collect the premiums that generates the investment float, and they invest it not passively in bonds as most insurers do, but in all kinds of other things which sort of spawned the big empire that they have now. So Geico is the banner, but property and casualty insurance markets have been ripping strong. Very strong market with pricing power and rising premiums, and that's sort of flatlining. So that's creating a bit of a headwind, we think, for one of their bigger business units.
All right, let's get in another email. This one's from John. What's your outlook on MDA Space? Are you a buyer now, and what's it going to take to push it a lot higher?
We are, John. We bought this company last summer, or actually last fall, after the first shoe dropped. They lost a contract. That created a dip in the stock and a good entry point for us. And there were other fits and starts along the way, but slowly but surely they're announcing new contracts, both civilian and increasingly military. So as a reminder, this is not a household name. The genesis of this company, it was the inventor of the Canadarm. Now it is a leader in low Earth orbit satellites, the primary use of which is in telecommunications applications. They're behind sort of the OnStar sort of driver assistance systems and various other things. And increasingly they're getting into military contracts with Canada and other NATO allies. So it's a good industrial, and it's one of the few sort of backdoor plays on the increasing defense spend in Canada. So we see a bright future here, and are encouraged by some of the recent contract announcements, and think that the valuation is undemanding given the size of the addressable market and the likely secular growth rate of that.
Okay, we're going to wrap it up there. We're a little late, but we don't have time for another email, unfortunately. But Brian, thanks as always for joining us, sir.
A real pleasure. Thank you, Roger.
That is it for us here on The Street. Again, thanks to Brian Madden, Chief Investment Officer of First Avenue Investment Counsel, for joining us today. And he's up with the open next. Trading gets underway a little more than 30 minutes from now. Have yourself a great day.